We're back finishing up receivables. We're going to talk about notes receivable. Just like accounts receivable, we have to put them on the books, and sometimes we have to write them off. Alright, so this class is the second tape for Monday, Wednesday, Friday, 25. So class 25B if you're Monday, Wednesday, Friday. If you're Tuesday, Thursday, we're in class 18, tape B. So the second tape for class 18, Tuesday, Thursday, folks. Alright, so what's going on here? Notes receivable. Remember, these are usually longer term. They're formal with a promissory note that's been signed. Notes receivable are more formal than accounts receivable. The debtor signs a promissory note as evidence of the transaction. The note receivable is recorded on the date that the promissory note is signed, and interest will have to be accrued periodically as necessary. So, note receivable. So, maybe you're lending money to an employee, or maybe you're lending money to somebody who couldn't pay an account receivable. Okay, well, you haven't paid your account receivable in 90 days, but you say you're going to pay it. Well, we're going to make you sign a formal note now, right? Something like that. So a formal note has a piece of paper, the promissory note, and here is one. So you can see it's got the principal amount, promise to pay, a maker, a payee, a maker, and a date, a maturity date. In order for a note receivable to be enforceable, it must be evidenced by a signed promissory note. The note must have four primary components. The principal amount must be stated on the face of the promissory note. The interest period must be identified, right? Interest period starts here, ends here. Interest rate must be identified, right? So they talk about, I promise to pay plus interest, 6%. And the promissory note must be signed. So here you go. So this is a note. So they promise to pay a certain amount plus interest, in this case $1,000 plus interest, over a certain period of time. So that's a promissory note, and it creates a note receivable. Alright, so that's it right there. So let's suppose we're going to put one of these on the books. Alright, so Smart Touch Learning lends Lauren Holland $1,000. Alright, 1 year, annual rate 6%. So what you do is you record the note. So think about this. So Lauren, I don't know, maybe Lauren's an employee who's having a hard time. They're going to help Lauren out. Or I don't know, just somebody who they're lending money to. Note receivable, right? So a note receivable is an asset, right? We're working our way down the balance sheet, so it's an asset. Receivable, we're going to get cash in the future. So note receivable is an asset, so we debit that as it increases, $1,000. But when we paid her out, we gave her some cash, so that asset decreased. So debit note receivable, credit cash, $1,000. Note interest is recorded only after time has passed. At the time of the issuance of the note, no time has passed. Hence, there is no interest yet to be recorded. Remember that all interest rates are always stated as annual rates. So that 6% is a yearly rate, all right? That's not recorded yet. Now, how do you calculate the interest? Well, it's pretty easy. I always think of it as PRT. Interest equals principal times the rate times the time. So the principal, in that case, so the amount of interest, principal, 1,000 times the interest rate, 6%, times the time, fraction of a year, right? Because interest rates are annual. So if it was 6 months, you'd put 6/12 or 1/2, 0.5. If it was 1 year, you just put 1, right? So 1,000 times 6% times 1 year is $60, right? So principal times the rate times the time, PRT, equals interest. At the end of the accounting period, if the note is not yet due, interest will need to be accrued. The approach is fairly straightforward. Amount of interest equals principal times interest rate times fraction of a year the note has been outstanding. So let's do this for our note. There you go, December 31. The loan to Lauren is not due, but interest must be accrued at a rate of 6%. Remember, at the end of the year, we do those adjusting entries to match our revenues and expenses to the period. Well, interest is a revenue. We're going to get some interest revenue. All right, she hasn't paid it, so it's going to be interest receivable, but we're going to record it so we get it in the right period. So here you go, 1,000 times 6% times 3/12, right? So 6% is for a year. It's only been 3 months, so 3/12 equals $15, right? So that makes sense because I said a whole year was 60, so half a year would be 30, so a quarter of a year, or 3/12, right, would be 15. The entry will require a debit to interest receivable and a credit to interest revenue, right? Revenue is always a credit. And it's called interest receivable because that's what we're receiving. The note is the 1,000. This is interest receivable, so it's separate from the note. So that's it. So at the end of the period, you put down any interest that you're owed by that person who has the note. Now, at some point, hopefully, they're going to pay you, right? Because that's the whole point. You gave them a note, and you wanted them to pay it back plus interest. So what does it look like when they do that? Well, so it earns 9 months. So that note was for a year, and it started at the end of September. So she owed you October, November, and December interest, and that was $15. So the rest of the year goes by, January through September. She owes you another 9 months, so that's $45, right? So she's accrued $60 worth of interest. 15 of it's already on the books as a receivable, and now she owes you the rest. So this is her paying you, paying the interest. We're taking care of all of it. We're taking care of the note receivable, the interest receivable, paying it off, getting rid of it, all that good stuff. So first you have to calculate how much interest she owes you for the remainder of the time, right? Because you've calculated the first 3 months, now you do the last 9 months. So we know it's a year, $60 minus 15, we know it's 45. But, obviously, to keep it consistent, 1,000 times 6% times 9/12 equals $45. So that's how much interest she owes you since January. The $15 was for the end of last year. Now you've got the rest of this year. So she owes you $45. But instead of putting it to interest receivable this time, like last time, right? So last year, we put it on interest receivable because she didn't pay us anything. She's just going to leave it owing till September. But now she's paying us, so we don't have to put it as a receivable. She's just going to pay us the whole thing. She owes us the $1,000 principal, plus she owes us $60 for interest. 15 from last year, 45 from this year. So she's handing over cash of $1,060. All right, so cash, $1,060. The note receivable, right, that asset is going away because she's paying us. So the asset note receivable gets a credit, 1,000. The interest receivable gets a credit, 15. And interest revenue gets the credit, 45, because, it is interest revenue, that's still there. So that's it. You collected that note and all the interest. So what happens when people don't pay the note? Well, we have to write it off, right? Same thing, when a maker dishonors a note, they call that dishonoring, right? So if a maker of a note does not pay at maturity, the maker dishonors the note, also called defaulting on the note. Because the note has expired, it is no longer in force. Dishonoring a note is a failure of a note maker's to pay the note at maturity. When a note receivable is deemed uncollectible or goes into default, it is often first transferred to an account receivable along with any unpaid interest. We then apply our account receivable policies to determine when this new account receivable will be written off. So, let's take a look at this. Suppose Rubenstein Jewelers has a 6-month 10% note for $1,200 from Mark Adair that was signed on March 3, 2007, and Adair default. So Adair came in and bought some jewelry, right? This happens a lot at jewelry stores, right? People buy stuff. Then maybe they didn't pay. Well, so you got to write that off somehow. So we're going to transfer it over to become a note receivable. All right, right, because then that accelerates its repayment, right? So we had a note, you didn't pay it, we're going to put it in our current liabilities and then apply our current liability write-off policy to it. So even though it's expired, they still owe you. I mean, it's not like it just goes away. They still owe you the money. So you're going to put it in accounts receivable. So here's how you do that. You take the whole amount, so you have to calculate the interest, 6/12, 1,200, 10%, 6/12, right? So once you've calculated that, you add it to what they owe you, and you call that now a receivable. So you put the $1,260 as an account receivable, $1,200 writes off the note receivable with a credit, and $60 accrues the interest revenue, assuming maybe you'll get it someday, with a credit. So even though the note has expired, they still owe you. Rubenstein will then bill Adair for the account receivable. This also allows Rubenstein to eventually write off using either direct write-off or allowance, however they work that. All right. Let's talk about a couple of important ratios called the acid test accounts receivable turnover and day sales in receivables. So a couple of more ratios that we care about that help us tell us about the business. Balance sheet can be used to calculate various ratios such as the acid test ratio, account receivable turnover ratio, and days sales in receivables. So here's an example company. Here's our assets and our liabilities, right down here. So using the information, we'll look at 3 common ratios used to evaluate business performance: the acid test, accounts receivable turnover ratio, and days receivable. The acid test ratio is the ratio of the sum of cash, cash equivalents, short-term investments, and net current receivables to total current liabilities. The ratio tells whether the entity could pay all its current liabilities if they came due immediately. The result is a ratio that gives us an idea of whether the company currently has sufficient current liquid assets to cover current liabilities. So if for some reason you had to pay off all your current liabilities, could you? Right? What do you have in the current assets? Next ratio, accounts receivable turnover ratio. The accounts receivable turnover ratio is computed by dividing net credit sales for the period by the average net accounts receivable for the period. Typically, average net accounts receivable is computed as beginning net accounts plus ending net accounts divided by 2. This number goes up. It is an indication that sales are slowing. So that's what we're interested in. How are things going at that company? Here's a ratio that can tell you if things are getting better or worse. Days receivable. Days sales in receivables. The day sales in receivables is the ratio of average net accounts receivable to 1 day sales. This ratio tells how many days it takes to collect the average level of accounts receivable. So if it takes a long time, you're not converting your receivables into cash. That's bad. You want those receivables to turn into cash, so you want it to be a short time. You want the number to be small. All right, so that's it on the ratios. That's it on this chapter. You know what the next thing is? The exam. So I will see you at the exam review, and I hope you do really well on it. Good luck.